thank you very much. I actually wanted to tie in Dr. Kemsey's before getting your forward-looking economist forecast. Can you talk a little bit about all this pressure on the U.S. balance sheet and what it might mean, or maybe it's a direct correlation to what's going on with the U.S. dollar, the FX impact?
Absolutely. The basic fact is as the population has been getting older, the demand for services has grown faster than the demand for manufacturing. And that would increase the cost of labor substantially unless we could move the factories to other locations where labor is cheaper. And we've seen a lot of outsourcing to China, even services we've tried to outsource to India. And to a certain extent, this has been good because it kept the cost of goods down for American consumers. But on the other side of the equation, the trade balance has become extremely negative. We import more goods than we export. And we have a small services surplus, but when you add these two together, it's an overwhelming trade deficit that's been in place now for a good 15 years. And the dollar has been under long-term pressure for some time, but with the economy being as weak as it is, the outcome can only be the dollar weakening further. If it hadn't been for the fact that the U.S. dollar is the sovereign currency of the world, it's the gold standard from the 1930s, and today the dollar plays that role, it'd probably be even weaker against some other major currencies. So obviously something has to be done about this, and part of the reason for our energy policy is half our trade deficit would go away if we didn't import fuel sources like oil into the U.S. It still doesn't solve the problem. The other part of it is the U.S. is going to have to push harder to export goods because at some point, if the U.S. doesn't do so, then we won't be able to buy things from other countries because we're not selling them anything, and holding green pieces of paper just isn't going to cut it. So there is a lot of negative pressure on the dollar, but we have to watch policy very carefully to see if there would be some stimulus for our exports.
Excellent, thank you. Now, if we could just get your perspective on a forward-looking basis, what you see for the global economy, your opinions on that, please.
Well, let's start. Fortunately or unfortunately, the story begins and ends in the U.S. The U.S. economy, U.S. GDP, represents 1 out of every $4 of global GDP. So you can't have a global economic recovery without the U.S. participating. And we took the world down, and we're going to have to help pull the world back up. And in our economy, 70% of our economy is consumer spending. But before we go into the consumer spending, let's just figure out why things have stopped getting bad. Because with unemployment at 10%, how can GDP be growing 3.5%? And the answer is that the housing market crisis seems to have stabilized. We had a 40% decline from 2007 till earlier this year in residential investment. That's no longer falling off a cliff, so that provides some relief. And businesses which had too many items in inventory, the inventory burn-off has pretty much come to an end. If anything, we're probably a little low on inventories. So these two factors which dragged economic growth down are out of the way. But we need the consumer to start spending, and here we have a problem. The banks are not in great shape to extend loans. They're raising interest rates on loans. They're rationing credit. And the people who've lost their jobs are the young people. So they don't have jobs so they can buy things, and they don't have access to credit. The baby boomers who have wealth and didn't really lose their jobs, they're kind of unhappy because, as Barbara pointed out, they're getting closer to retirement. They lost some wealth, so they're going to have to save a lot in order to be able to retire. So they're not going to spend a lot, and therefore the engine of growth is pretty much running at a relatively flat rate. So we are looking at relatively low growth rates, and people call it a bumpy ride. You call it whatever you want, but the outlook is for a relatively slow recovery. Now, just to close on this point, and David had brought this up, we have to be concerned about the excesses that have built up in the economy. And the Chinese economy can produce a lot more goods than it can consume. And they need to sell it in places. So there is global excess capacity in many industries, which creates a deflationary trend. And this is why the Federal Reserve, the European Central Bank, Bank of Japan, et cetera, have cut interest rates practically to zero and pumped money into the economy. So we're trying to fight deflation because a debt deflation cycle is death. It's what happened in the 1930s. But once things get going, with all that money in the system, we could get a lot of inflation very quickly. So over the next couple of years, as the economy begins to recover, the policymakers have to pull that support out at just the right speed. A little too fast and will provoke another recession and deflation. If they don't do it fast enough, then we could end up in something of an inflationary spiral like we saw in the latter part of the 1970s. So it is very tricky, and the policymakers are in a difficult spot. But I am a little more confident today than I was 18 months ago, because 18 months ago I couldn't understand why the Fed and the European Central Bank were worried about inflation when clearly leverage was the problem. And today it seems to be that they're all focused on the right things.
Excellent, excellent. Thank you, Dr. Kemsies. David, can I get your perspective of what you were helping your clients do coming out of this crisis, going forward? Are you seeing a less appetite for risk when you're speaking with your clients, when you're designing portfolios? Speak to that for me, and then let's follow up on similarly on the FX question, if you wouldn't mind.
Sure. In terms of the appetite for risk, we are not seeing a diminished appetite for risk in terms of overall market risks, exposures to the bond market and the equity market, because clients understand that in order to earn returns, one has to accept some degree of capital market risk. We do see clients that have become much more sensitive to other types of risks, such as management risks, organizational risks, headline risks, and those types of management-related risks. They're very concerned about asset liability management and liquidity risks. So we're working with clients to eliminate those risks from the portfolio, focusing on the broader asset allocation decision to take on market exposures. We're also working with them to select advisors that we think offer sound operational procedures and have a strong investment thesis. Regarding the foreign exchange opportunities that Walter talked about, there are some very significant opportunities for investors today. The U.S. market represents only 42% of the world market. The rest of it is overseas. And by investing broadly in a globally diversified portfolio, an investor can gain access to some of the higher growth economies outside of the U.S., and an investor can also hedge the dollar.
Right. Excellent. Can you also give us your opinion on your outlook on inflation and what you may or may not be doing in defending that in your client portfolios?
The outlook for inflation is certainly very challenging. We do think that the risk of a policy error is significantly higher today than it was several years ago. I would agree with Walter that the risks have diminished somewhat in the last few months, but certainly the risks of inflation or deflation appear to be much higher now than they were several years ago. If you look back at the very adverse episodes of deflation in Japan in the 1990s, inflation we had in the 1970s, deflation we had in the 1930s, those bouts of inflation and deflation were certainly caused by policy errors by the central bank and by the government. We think it's actually very difficult to forecast, to predict with any accuracy whether we'll have inflation or deflation. We do think a sensible approach is to diversify the portfolio and invest in certain assets that will provide inflation protection and certain assets that will provide deflation protection. We think in terms of inflation protection as tips, commodities, and maybe real estate when the pricing improves. Interestingly, tips offer deflation protection as well as inflation protection. So that's a nice way to achieve protection against both extremes.
Excellent. Were there any additional points you'd wanted to make?
No, I think that covers it.